Having a solid grasp of fundamental financial concepts can significantly contribute to making more informed financial decisions. Financial literacy empowers you to analyze news, understand trends and business announcements, and effectively manage personal and professional finances. In this video, we list 10 basic financial concepts and provide a baseline explanation of each. First on the list is inflation. Inflation is the process by which the general level of prices for goods and services increases over time, leading to a decrease in the purchasing power of money. While most people understand the basic concept, it's important to consider the additional implications. As the price of goods and services rises, the value of a dollar decreases. For example, with a 5% annual inflation rate, the dollar's value drops to 95% after 1 year and is cut in half in about 14 years. This erosion of purchasing power can have significant consequences for your income and savings. When negotiating your salary, it's important to take inflation into account. If your boss offers a 3% raise when inflation is 5%, you get a pay cut of about 2%. Similarly, cash left uninvested in a bank account can lose value due to inflation. While the impact of inflation may be negligible for small amounts of money over short periods, it can be a major concern for long-term savings and investments. Understanding the effects of inflation is essential for making informed financial decisions and protecting your wealth. Second on the list is compound interest. Compound interest is a powerful financial concept that can significantly impact your wealth. When you invest, your money grows exponentially, earning interest on the interest you've previously earned. This compounding effect makes it easier to build wealth over time. The longer you invest, the more significant the impact of compound interest, as a larger portion of your total earnings comes from interest rather than your initial investment. Understanding its power allows you to leverage this concept to build wealth without saving millions. Instead, you can let compound interest do the heavy lifting by consistently investing even a small amount of money. People need to grasp this concept, as it can encourage more individuals to invest and secure their financial future. Third on the list is bear market. Bear markets are a normal part of the stock market cycle and should not cause panic. While they can be unsettling, it's important to remember that these events are not unusual and have occurred throughout history. It occurs when the market experiences a 20% drop from its all-time high. The S&P 500 has encountered on 22 occasions since 1928. On average, these bear markets happen every 4.5 years and typically take around 388 days to recover. Awareness of the potential for market crashes is crucial for investors, as it can help prevent emotional decision-making during downturns. By understanding that market crashes are a normal part of investing, you can avoid making rash decisions, such as selling everything in a panic. Instead, focus on your long-term investment goals and remember that the market has historically recovered from these downturns. Fourth on the list is bull market. Contrary to a bear market, a bull market indicates the market is on the rise, indicated by an increase in stock prices and a low level of unemployment over an extended period. Typically, a bull market indicates that the economy is healthy, although financial professionals consider many factors when determining the health of a market. Investors are eager to buy securities in these markets, creating a buyer's market. It's important to remember that markets are in constant flux, meaning a bull or bear market doesn't always last forever. Next on the list is credit. Credit typically refers to the ability to purchase goods and services or borrow money with the agreement to pay later, generally with interest. It represents an agreement between a lender and a borrower, also known as buying on credit. There are many forms of credit, the most popular being bank or financial credit, such as loans, mortgages, signature loans, and lines of credit. In accounting, credit also refers to a bookkeeping entry that signifies either a decrease in assets or an increase in liabilities on a company's balance sheet. The next concept is net worth. Net worth is a crucial indicator of your financial health, providing valuable insight into your financial situation. It's calculated by subtracting your liabilities, debts, from your assets, everything you own. Tracking your net worth from an early age can help you monitor your financial progress over time, making it easier to see the long-term impact of your financial decisions. A positive net worth indicates that you're in a good financial position, while a negative net worth may signal that you have some work to do to improve your financial health. By regularly monitoring your net worth, you can make more informed decisions about your finances and stay motivated to work towards your financial goals. Next on the list is liquidity. Liquidity refers to the accessibility of money or the ease with which you can convert assets into cash. Regarding assets, the most liquid of all assets is cash itself, whereas tangible items are less liquid. For example, real estate is generally not very liquid as it takes time to build value, and selling these assets can also take time. The two main types of liquidity are accounting liquidity and market liquidity. Accounting liquidity refers to a business or individual's ability to meet financial obligations if their debts are due. Market liquidity refers to the extent to which a market, such as a real estate market, allows assets to be bought and sold at transparent prices. If markets aren't liquid, it's difficult for sellers to convert their assets into cash. Next up is risk tolerance. It refers to your ability to handle ups and downs of the stock market, and it can vary from person to person. High-risk tolerance individuals may view market downturns as opportunities to invest more aggressively, while those with low-risk tolerance might be hesitant to invest or even avoid it altogether. Risk tolerance is not solely based on emotions. It also depends on factors like age, investment horizon, and financial goals. Taking on too much risk can lead to significant losses, while being too risk-averse can result in missed opportunities for growth. When investing in the S&P 500, it's important to know that the index has historically experienced an average 20% drop every 4.5 years. To balance risk and reward, you may consider target date funds or an S&P 500 index fund, which can help you achieve a more moderate risk level. Next on the list is the time value of money. This is the idea that $1 today is worth more than $1 in the future, as it can be invested to grow through compound interest. When you have $1 now, you can spend it or invest it to increase its value over time. For example, if you had invested $100 in the S&P 500 30 years ago with a 10% average annual return, it would be worth over $600 today, even after adjusting for a 4% inflation rate. Understanding this concept can help you make more informed decisions about spending and investing. By considering the potential growth of your money, you may be more inclined to avoid unnecessary purchases and prioritize long-term financial goals. Last on the list is asset allocation and diversification. It means categorizing an investment portfolio into items such as stocks, fixed income investments, cash and cash equivalents, futures, and alternative assets. Diverse asset allocation is an important aspect of an investment strategy, as it's important to variegate assets into several different asset categories. This approach helps manage risk tolerance and may improve overall investment objectives. A more diverse portfolio might indicate lower risk and may yield a larger return over the long term. These essential money concepts are not difficult to grasp, but the earlier you understand them, the better prepared you'll be to make sound financial decisions. By learning these concepts now, you can avoid regret and set yourself up for a more secure financial future. If you found this video helpful, make sure to like and subscribe for more content on personal finance and investing.